Right, we're going to start with question 2.1. You need to choose the correct word from those given in brackets. Write only the word next to the question number in the answer book. Right, 2.1.1, balance of payments deficits can be corrected by increasing or decreasing interest rates. So here we're looking at the balance of payments, and the key word there, we're looking at the deficit. A deficit, remember, it's a loss. So how can we rectify this loss? The only way to rectify this loss is when we increase the interest rate. So by increasing your interest rate, you will rectify the balance of payments deficit. So the correct answer is there. By increasing the interest rates, that will result in a balance, or you could then rectify the situation with regards to the balance of payments. Then 2.1.2, a deliberate measure by the state to reduce the value of a currency is known as, and our options are devaluation or depreciation. Depreciation can only happen with current and fixed assets, and those that do accounting will know that an asset will depreciate over a period of time. So the more time you have the ownership of the asset, then the asset will depreciate. And there are a few assets that appreciate, like property. Property will appreciate. You may find that you bought the house for R1 million, but when you sell the house, it's worth more than R1 million. So that's called the appreciation. But then in most cases, an item like a vehicle, because you use it up on a daily basis, it will depreciate. But with a currency of a particular state or a country, it will devaluate, because devaluation will take place where the government, with an intention, so they have an intention of doing this, they will then reduce the value of the currency because they want to rectify a particular economic situation. So the correct answer there is devaluation. Right, then the next question, consumer preferences or technology are or is a factor influencing the efficiency in the production of goods and services. So we're looking at production. What is it that will influence on making sure or ensuring that there's efficiency in the production process of goods and services? Consumer preferences has absolutely nothing to do with this, but the technology that is used in the process will result in a better product coming up. So it will be a factor that will influence the efficiency. So the correct answer there is the technology. Labor is traded in the factor or the financial market. So we're looking at labor. Labor, when you go and work and you earn an income, and then that's considered as labor. So when we trade it in the market, it's regarded as a factor, and it's not the financial market, but it's regarded in the factor market, not the financial market, because you are contributing skills and expertise, and then you get remuneration based on those skills and expertise. Right, moving right along to 2.2, you need to list any 3 factors influencing demand for foreign exchange. All right, so now why do we need foreign currency in our country? What good does it do for our economy? Number one, for imports. So when foreign countries bring their products in our country, for example, France will bring their wine into South Africa, then they will pay us in using the euro, and we know that the euro is slightly higher in terms of value compared to the rand. So that is good for us. They're paying us in euros, and when we convert that money, then we get more money. Same thing with the pound. When we have people that import goods into our country and then they pay us using a pound or the dollar, then that creates more money. So there's an influx of foreign exchange, or there's a cash injection that happens in the economy. So that's the first reason. The second reason looks at the investment opportunities. If you go and invest in one of the Swiss banks and you invest your money there, or the states decides to invest there, when we get paid the interest from our investment, we get paid in their currency. So also there's an injection of foreign currency into our economy, which is good, because then it brings more money and it allows for more economic activity to take place. Also, we're looking at the payments that happen when people pay us from the foreign countries. So if people from the UK pay us and then they pay us in their currency, and therefore we convert that and it becomes more money in the South African economy because their currencies are much more stronger than the rand. So you needed to mention 3 factors there. So we've mentioned imports, we've mentioned investment opportunities and the interest that gets paid, and we've mentioned payment if we export our products, and then the payment will be done in the foreign currency. Although when we have to pay charges, the tariffs charges, then we get charged more. Right, question 2.3, you need to study the table on the calculation of GDP and answer the questions that follow. So if you have a look, we've got the calculation of GDP according to the income method, and these were figures sourced in 2007, and they've given us the source. It's from the quarterly bulletin of the South African Reserve Bank. All right, so they've given us all the information that we need from the table. So we've got all the figures and all the information. So let's just go straight to the questions. Right, the first question says you need to differentiate between GDP and GNP. All right, so that's a very nice question where you do the comparison. Also, this is a contextual question. You need to know your work quite well in order for you to tell the differences between GDP and GNP. All right, so we learned in economics that the GDP looks at the total value of goods and services that were produced within the boundaries of a country over a specified period of time. So we're looking at the total value, that these were the goods that were produced from November 2008 to November 2009. So it has to be for a specified period of time, and also it has to be produced within the boundaries or the borders of South Africa. We're not talking about goods that are produced in Botswana or in Swaziland or in Lesotho. It has to be within our boundaries in South Africa. So that's the GDP. Now the GNP looks at the total value of goods and services that were produced, but in GNP we're looking at the permanent residents, people who have citizenship in this country. So those are the people that will be counted in those figures, and also it has to be over a specified period of time. So these are goods that are produced. It's a total value of goods and services that are produced by permanent residents of South Africa over a specific period of time. So now your comparison needs to show the difference. So they are both total value of goods and services produced, but for GDP it has to be produced within the borders or the boundaries of South Africa, and with GNP it has to be produced by the permanent residents of South Africa. So that's the difference between the two. Right, for 2.3.2, which alternative term is used for GDP in the national accounts? So what do we call GDP when we use the national account? So we call it the gross value added. So when we use the method of a gross value added for GDP, so if we go back to the table, we can see that there we go, that's gross value added. That will be used on behalf of our GDP. So they've used the alternative term as gross value added. So you need to be careful. Guys, you can see that at times the answers are just there in the paper. You just need to look for them. See, they've given us the answer for the second question and it's in the table. So when they say study the table, you need to make sure that you study the table. You look over the facts quite carefully. You may highlight on your question paper if you come across something that you think is of absolute importance, then you may use a highlighter to highlight that, because you can later just go back and source that information. So gross value added will be another word used for GDP. All right, now they say we need to provide labels for A and C. Okay, so let's have a look at labels A and C. So if you have a look over here, here's our table. And for A, we've got the gross added value over there. So what is A? we look at the gross added value. So over here, gross value added at, and then that's the answer that we need to provide. So A will be the factor cost. So that's the cost at this cost. So that will be the factor cost over there. So the label for A will be factor cost. And then the label for C will look at the taxes, because then at basic prices, and then the tax rate on a product will be placed there on C. So for A, that's the factor cost. And then for C over here, we're looking at the taxes that will be charged on these products. All right, so 2 marks for each label that you have supplied. So that was just an easy way of getting marks for that. Now we move right along to question 2.3.4. You need to calculate the gross value added at basic prices, which is letter B. So now we go back to our table. We're now required to calculate the gross value added on basic prices, which is letter B. So now, how are we going to do that calculation? So let's have a quick look then. All right, so if you have a look over here, so we need to look at what we're working on from our figures. So we're working in rands, and it's a billion, that's BN. All right, the main focus is here on number B. Okay, so now we need to show the calculation for that. All right, so we first need to find the 1742 billion, which is our GDP, or our gross value added. So we need to take that out. And then we need to plus that with the taxes on production. So what are the taxes on production over here? The taxes on production are 35 billion rand. And then there's a subsidy that is provided on this. So there's a subsidy. When there's a subsidy provided, it means it's some sort of allowance that is provided. So we need to subtract the subsidy from the total. So we're going to take that, which is now number 1, plus that, which will be number 2. And then we need to find the subsidy. Okay, so where's the subsidy? Here's the subsidy over here, and we need to take it away. So we have our GDP plus the taxes, and then now we need to subtract the subsidy which is 6 billion rand. So if you take 1742 billion plus 35 billion and you minus 6 billion, your answer there will be 1771 billion. Okay, guys, you just need to know where to find the information. Remember, here we are asked to work on the gross value added. So we're working here. Okay, so here is the gross added value. So we take our GDP plus the taxes, and then we subtract the subsidy that is granted on that particular product, and then our correct answer there will be 1771 billion rand. Right, 2.3.5, which component contributed most to the gross domestic product? So we need to find out which item contributed most to our gross domestic product. Remember, our GDP, we said these are the total value of goods and services that were produced within the boundaries of our country. So that is the boundaries within South Africa. So now, which factor contributed most from this? So we need to go back to our diagram, and we need to look at the different factors. So we've got the compensation of employees, the net operating surplus, and the consumption on fixed capital. So if you have a look between those three figures, you can see that the compensation of employees was the major factor on our gross domestic product, because it amounted to 843 billion rand, and that's a huge amount. So it definitely had a huge impact. And you can see it's the highest figure there that we have. So it was the major factor that played a role in our gross domestic product. So the correct answer there is the compensation of employees. Right, now for 2.3.6, you need to give a reason why the GNP figures in South Africa are generally lower than the GDP figures. All right, the reason, remember we said GNP, those are the total value of products that are produced by permanent residents, and the GDP are the total value or the total figures of goods and services that are produced within the boundaries of South Africa. So it's not looking at whether it was permanent residents or was foreign residents who made that particular product, as long as that product was produced within the boundaries of South Africa. So now, why is the GNP lower than the GDP? Right, the major reason is that we are so dependent on foreign goods and foreign investment in our country that our own investment alone could not rise up the GDP figure. So the major reason we are dependent to foreign investment and imports from other countries to grow our economy, we rely a lot on the cash injection and the foreign currency that is brought along by foreign countries, because they have a stronger currency than us, and therefore it creates a huge injection of cash within our economy. So that's the major reason why the GNP in most cases is lower than the GDP. All right, so that's a nice question where you've asked to compare those two. Remember, in the first question, you were asked to distinguish between the two. So if you did not study for this in your notes and you did not go over it properly in class, it would make it even more difficult to be able to answer this question, because you need to have facts and knowledge and be able to do the comparison and know the difference, that the one looks at producing goods or the total value of goods within a country, and the other one looks at permanent residents that make particular goods over a specified period of time. All right, we move right along to question 2.4. With the aid of a Laffer curve, you need to explain the relationship between tax and revenue. All right, so in the question itself, it tells us exactly what we need to do. We need to be able to explain the relationship between tax and revenue. We know that the government collects its revenue mainly from taxes that get charged, starting from company tax into individual tax, and also tax on products, on certain products. So now we need to work out the relationship between the two, between the taxes and the amount of money that is collected by the government. And we know that SARS is responsible for that, and they're very efficient when it comes to collecting tax. So you need to make sure that when you start working, you pay your tax and you do not fall behind with your tax payments. All right, so let's have a look at this. So now, the first thing that you need to do, the actual curve. So you need to do your y-axis and your x-axis, and then you need to label your graph. So we're looking at tax revenue. That's my heading that I've put there. And then we've got the amount in rands, and then we have the taxes over here. So we're looking at how tax and revenue go together, and the relationship and how they affect each other. So if there's a decline in one, obviously the other one will be affected. So the first comment that you're going to write is that this curve looks at the relationship between tax and revenue. Right, so here at 0, if there isn't any money collected from taxes, the government will be unable to make any revenue. So revenue is the income that the government collects, and they use that money to build infrastructure and to improve the resources in our country. So here, at this point, it means that if there is no tax collected, then there'll be very little revenue, or there'll be no revenue that the state will collect. Right. Also, the government is quite aware that if the tax rate is high, or it's extremely high, or it's too high, or it's considered to be not reasonable, then there will be a lot of tax evasion that goes on and tax avoidance. So if the tax becomes quite expensive and people feel that, you know, they're not coping and they can escape paying tax, and then there's tax avoidance. Okay, so they need to work it out and balance it, and always try and keep it above T, because if it's anything above T, will be considered unreasonable and expensive. So at this level, then we've got a lot of tax evasion and tax avoidance. So most countries will always keep it below T, and anything above T will be considered to be expensive, and people will start trying to dodge and do reconstruction accounting and try and balance the books and do things that are not there. And then if you have a look at T1, we've got the tax rate at 1% in that space. Okay, which we can't be in that situation. A tax rate has to be reasonable. So, for example, on companies, it's sitting between 30 to 35%, which is a reasonable amount. But once you move to 100% tax rate, that's unreasonable. I mean, people will just run away from paying tax. So we try and avoid that situation. So the best way for us to keep our taxes will always be below T. So then our equilibrium point for the tax collection will be here. And once we're in that bracket, then we're safe, and then we can get people to pay their taxes and to respond quite well. All right, then there's also evidence that suggests, like I've mentioned, that when the tax rate is above that, so there's been research that's done to see the response of people, how people respond to that. So people will say that if it's above T, it will be considered unreasonable and they will not pay tax, and that will be bad for the state, and there will be no revenue collected. So now, in summing up your answer, you need to say that the government needs to keep the tax at a reasonable rate, because if they go above what is considered to be the reasonable rate, then there will be a lot of tax avoidance that takes place. So they need to make sure at all times that they stick to this and that they do not go above the T bracket, because anything above that will be considered unreasonable. Okay, so those are some of the responses that you can include in your discussion, and you just need to expand and give examples and say that if it's higher than this, then it will result in tax avoidance. And say, for example, in a private household, if the father earns a certain amount of money, then he has to pay a huge portion of that money to the state, then he's unable to look after his family, and therefore they can't survive because of the tax rate. So the tax rate has to be kept at a reasonable time or a reasonable place, and that will create a good relationship between the tax and the revenue, because when people can afford it, they will pay it, and the state can collect money from that. All right, so that brings us to the end of question 2.4, and we're going to move right along to question 3.